The market has a peculiar way of whispering before it shouts. Most traders don't hear it. They're too busy reacting, chasing every tick, every rumor, every flashing price. But the market always gives signals, it's just that very few have the patience to see them. The art of identifying reversals isn't a secret formula. It's the disciplined observation of cause and effect of emotion and exhaustion of the moment when supply quietly gives way to demand or when demand finally surrenders to supply. When I first began in bucket shops, all I had was price. No fancy charts, no algorithms, no data feeds, just the tape. That endless roll of numbers taught me how human nature moves in waves of hope and fear. Every reversal begins long before the price turns. It begins in the minds of traders. The crowd is always late because it acts on emotion, not observation. To identify reversals, you must train your mind to read emotion through price. Let me walk you through the process I've followed for decades, a process forged in both profit and ruin, refined through every victory and loss. The first step is observation. Before you can ever act, you must learn to stand aside and watch. Most traders rush in too early. They see a dip and think it's a buying opportunity. They see a rally and assume it's time to short. But a true reversal doesn't announce itself in one bar or one move. It develops. It matures. You must observe how the market behaves after an extended move. When prices rise too quickly, when every headline screams bullish optimism, and when even the most cautious traders start boasting about their gains, that's when I begin to take notice. That's when I stop trading in the direction of the move and start studying the reactions. The second step is recognizing exhaustion. Markets, like men, tire after exertion. An uptrend that's run its course will start to show signs of strain. Volume surges, but price fails to make meaningful new highs. You'll see wide, erratic bars, wild fluctuations, and sudden reversals intraday. It's the same on the downside. Panic selling reaches a crescendo, yet prices no longer fall sharply. The tape begins to move slower, as if the selling pressure is running out of steam. These are the first whispers of reversal. I remember watching such behavior before one of the great declines. Prices had been rising for months, but near the top, every rally was met with heavy selling. Traders were euphoric, talking about how this time was different. But the tape told another story. The upward thrusts were shorter, the pullbacks deeper, and volume began to shift more on down days, less on up days. That's the footprint of distribution, the quiet exit of smart money. The crowd didn't notice, but the tape revealed it. The third step is confirmation. You can't act on the first sign of weakness or strength. That's guessing, not trading. A reversal only becomes real when the market confirms it. The confirmation comes when price breaks a key level that had previously acted as support or resistance. But more than the price itself, you must watch how the market reacts after that break. If a market breaks down and fails to recover, if every rally is met with renewed selling, that's confirmation of a new downtrend. Conversely, after a long decline, when price breaks above resistance and holds when pullbacks are met with buying, that's confirmation that control has shifted. Patience is the hardest part. Many traders see the first signs and jump too soon. I've done it myself, and it cost me dearly. You can be right about direction, but wrong about timing, and the market will punish you all the same. Waiting for confirmation requires the discipline to sit on your hands while opportunity forms. But once the market confirms your observation, you can act decisively. The fourth step is positioning. Once you've confirmed a reversal, you don't rush in with your full position. You scale in. You test your judgment with a smaller position first. If the market moves in your favor, you add. If it doesn't, you cut your loss quickly. That's how professionals survive. Every trade is a test, not a declaration. You must never try to force the market to prove you right. The market doesn't care about your opinion, your analysis, or your conviction. It only respects discipline. Risk management is what keeps you alive long enough to profit from reversals. No reversal is certain until it's well underway, and even then, it can fail. My rule was always to limit losses quickly and mercilessly. If I bought expecting a reversal and the price didn't behave as it should, I was out. No arguments, no hoping. Hope is for those who don't understand probabilities. Discipline is for those who do. One of the most revealing signs before a reversal is volume behavior. When a stock has been rising for weeks, yet the last few rallies happen on declining volume, that's weakness. When a market has been falling for months, yet the last few drops come with diminishing volume, that's strength. Volume tells you who's still participating. When the smart money begins to withdraw, you'll see the tape grow thinner. Prices might still move, but they move without conviction. Another clue is the reaction to news. During an uptrend, if good news fails to lift prices, it's a warning. During a downtrend, if bad news fails to push prices lower, it's a signal of change. The market always discounts the future. When it stops reacting as expected, it means the crowd has overplayed its hand. The turn is near. There's a certain rhythm to reversals that never changes. It's the rhythm of crowd psychology. First, there's denial. People refuse to believe the trend is ending. Then comes hesitation. They start to question, but they still hold. Finally, there's panic. Everyone rushes to exit at once. The last buyers at the top and the last sellers at the bottom are the emotional ones. If you can keep your head when everyone else is losing theirs, you'll find opportunity where others find ruin. I learned the hard way that reversals don't happen at round numbers or technical lines alone. They happen when sentiment reaches an extreme. You can measure that through behavior, how traders talk, how they act, how the market breathes. During one famous bull run, I recall visiting a broker's office. The place was packed, everyone shouting buy orders, clerks sweating over the phones. Men who had never traded a share in their lives were giving stock tips. That was my signal to prepare for a fall. I didn't know the exact day, but I knew the end was near. Excessive enthusiasm is the enemy of continuation. When studying a possible reversal, I always ask myself 3 questions. First, who's in control, buyers or sellers? Second, who's getting tired? Third, where are they likely to surrender? The answers to those questions reveal the turning point. When the dominant side begins to tire, when their effort no longer produces the same result, that's when the reversal seeds are planted. Most traders make the mistake of assuming the market turns sharply and suddenly. But the truth is, reversals are a process, not an event. It's accumulation at the bottom, distribution at the top. The smart money buys when it's quiet and sells when it's noisy. The crowd does the opposite. They buy when everyone's talking about opportunity, and they sell when panic screams from every headline. The reversal is the moment when the smart money and the crowd switch places. To identify that moment, you must cultivate emotional detachment. You can't fall in love with your trades, your opinions, or your analysis. The market doesn't owe you validation. It only rewards observation and discipline. When I was younger, I'd get attached to being right. I'd argue with the tape, refuse to cut a loss because I wanted to prove my theory correct. That arrogance cost me fortunes. The tape is never wrong. It might be confusing, it might be deceptive, but it's never wrong. When price and volume tell a story that contradicts your bias, listen to the tape, not your ego. The greatest traders aren't those who predict every reversal. They're the ones who manage risk so that when they do catch a reversal, they can press their advantage. When I caught a major turn, I didn't just take small profits. I built the position slowly, adding as the market confirmed my direction. Each add-on was funded by profit, not hope. That's how you compound your edge without compounding your risk. Now let's talk about false reversals, because not every change in price means a new trend. Many traders get trapped by short-term fluctuations. A strong counter-move in an existing trend can look like a reversal, but it's just a reaction. The difference lies in follow-through. In a true reversal, the follow-through builds strength in the new direction. In a false one, momentum fades quickly. Always test by waiting for the second move. If the market confirms by holding above or below the previous reaction level, then the reversal is real. If not, it's noise. There were times when I ignored that rule and paid the price. I once shorted a rally that looked exhausted. Volume was drying up, prices were stalling, but the market wasn't ready to turn. It shook me out and then fell without me. I had the right idea, but wrong timing. That's why patience is the most expensive and most valuable trait in trading. You can't rush reversals. They'll come when the market's ready, not when you are. There's also the matter of market context. A reversal in one stock might mean nothing if the general market trend remains strong. Always study the broader market. Individual issues follow the tide. If you see multiple sectors showing exhaustion together, if leaders begin to falter, that's when you pay attention. Market tops are led by the breakdown of leaders. Market bottoms are led by strength, returning and leading issues. The leaders always turn first. Watch them. Emotional discipline, again, is everything. When you're analyzing reversals, you're essentially watching the struggle between greed and fear. Don't participate in it, observe it. The crowd feels greed at the top and fear at the bottom. If you can feel the opposite caution when others are euphoric, curiosity when others are terrified, you'll be on the right side of most turns. Reversals also tend to align with time cycles, periods of accumulation and distribution. Nothing moves in a straight line forever. Price always needs to correct, rest, and gather energy. When you notice that the length of each rally or decline is shortening, that's another signal that a reversal is near. The market's rhythm begins to compress before it expands again in the opposite direction. When you finally catch a reversal, don't expect it to pay off immediately. The market tests conviction. It moves against you just enough to shake the weak hands. That's why your position sizing and stop placement matter. Never risk so much that one shakeout destroys your confidence. Risk small enough to stay objective. Your first job is to survive. Profits come to those who are still standing after others have been wiped out. Let me tell you a truth most traders never learn. Identifying reversals isn't about being clever, it's about being patient. The crowd trades emotion, the professional trades behavior. Every reversal is a story of imbalance correcting itself. The wise trader reads the story, waits for the ending, and only then takes his part. Over the years, I've found that reversals are where the biggest fortunes are made and the biggest losses occur. The difference lies in discipline. I've made millions catching them, and I've lost millions ignoring my own rules. The process never changes. Observe, recognize exhaustion, wait for confirmation, position carefully, and protect your capital. Do that, and the market will eventually reward you. But never forget, reversals are not gifts, they are tests. They test your patience, your nerve, and your humility. The market will always tempt you to act before the turn is ready. Resist. Let others be the first to guess. You'll make more money being right late than wrong early. So the next time you sense a change in the air, a shift in volume, a hesitation in trend, a growing unease among traders, don't rush to predict. Step back, observe, and let the market reveal its intent. When the tape and your judgment align, act with conviction. When they don't, do nothing. Doing nothing is often the most profitable decision you'll ever make. In the end, the art of identifying reversals is really the art of understanding human nature. The market is nothing more than a reflection of people, of their fear, greed, impatience, and hope. Master your own emotions, and you'll see theirs more clearly. When you do, reversals won't surprise you anymore. You'll recognize them not by what the price says, but by what the crowd feels. And that, my friend, is when you'll know the market has turned.